Good evening, family, and welcome to another installment of Your Wealthy Wallet Wall Street course. We back at it again, because we got to get this money. But today we're going to start talking about stock market investing 101. So now it's time to start jumping in. It's time to start getting into the game. It's time to start playing it for real. See, the first part of this class, we learned about technical analysis. Now we're about to start jumping in a fundamental analysis. So we want to go ahead and get started, but it's time for you to start jumping into the market. So that leads us to understanding what day trading and swing trading is, because you got to understand how to play the game. You got to understand the rules, because you cannot beat the game if you don't know how to play the game. So we're going to first start out with day trading and swing trading if you already don't know what it is. And if you've been trading and you really don't understand what swing trading is or day trading is, we're about to find out. So let's talk about it. What is day trading? Day trading is when you buy and sell stocks on the same day, and a swing trade is when you trade inside a few days or a week. But before we go in a little deeper in this, please don't forget to subscribe, follow, or like. If you find this information to be very valuable to you, please hit the subscribe button, that follow button, or that like button. It's a way of telling the social medias and YouTube that, hey, man, this content's pretty good and we want more of it. But let's go back into it. So when you day trade, right, was when you buy and sell stock on the same day. So if I buy Apple on the same day, right, and I sell it the same day, that's day trading. And swing trading is when you trade inside of a few days. So if I buy Apple on Monday and I wait to sell it on Wednesday, that's swing trading. But it is against the law to day trade four times a day or four times a day inside of a week on a trading platform unless you have 25,000 in your brokerage account. Let me say it again. It is against the law to day trade four times a day or inside of a week on a trading platform unless you have $25,000 in your brokerage account. So if you get caught trading four times within a week, within a 5 day span period on a brokerage account, they're going to suspend your account. They're going to lock you out of your account, because when you trade more than four times a day or within four times in a 5 day period or a week, you would be considered as a pattern trader. And they don't like that. You know why they don't like that? Because they don't want the poor people getting rich. They don't want the poor people to jump in. They don't want people who really don't have no money to figure out how to play the game in the stock market. That's why it starts at $25,000 for you to be able to day trade. How many people in the hood got $25,000 free? Not many people. Not many people in the hood got $25,000 free. Where are you gonna go find $25,000 in the hood when everybody is scraping just to get by every single day, right? But but in order to be a day trader, you have to have $25,000 in your account from the previous day in order to trade, five or six times, jump in a stock and then jump right back out of stock, jump in a stock and make $500-600 and then jump back out of it because you really don't care. You're not married to this stock. You just on a dating swing. You've been a little a thought. So you're switching around and jumping around into different little stocks, right? But you can't do that unless you have $25,000 in your account. So if you don't have a $25,000 in your account, you might as well go ahead and forget about it, because you cannot day trade and you don't want your account locked. But there's ways around that. There's always ways around it. That's why and that leads us to the next line, to the next sentence. That's why you need to have multiple accounts to increase your trading abilities for a week. So, we talked about starting out in the very beginning of this course. We got Fidelity, you got TD Ameritrade, you got Robinhood, you got Webull. There's many of different brokerage accounts that you can open to be able to trade multiple times. So, if you got three different accounts, so you got three different accounts, that means you can day trade 9 times within that week, right? You can day trade 9 times within that week. So that's why it's good to have multiple brokers account until you get 25,000 in one of those accounts. And then you don't have to uh, go jump from platform to platform as much until you get 25,000 in there. But in order to beat the system, right, you have to learn the system. So, and by us learning this system that we cannot trade more than 4 times in a day or within a 5-day week, or unless we'll be flagged as a pattern trader, then we get multiple accounts, right? We get multiple brokerage accounts. That way we go and trade 3 times on Fidelity, 3 times on Webull, 3 times on Robinhood. You see a nice play that we only want to date for the day, then okay, I'm gonna jump in it on Robinhood. We see another nice play the same day that we might want to date. Oh, I'm gonna jump in it on Webull. Boom, and now you're not gonna get flagged as a pattern day trader. But when you're jumping into these moves, you need to be making sure you're writing all these things down. That's why you need to go keep a pen and a pad, a piece of paper next to you that logs all of your trades so that you don't get caught up and you might have forgot that, dang, I traded 3 times on Robinhood. Now you go and trade 4 times and now you locked out of your account, or you go over here and you trade and then you locked out of your account again. And you want to keep a journal of every trade that you make. So you need that data, not just to get yourself confused, but you need that data also to help you understand and help you to grow as a trader, as an investor. If you're just jumping into things and you don't know when you jumped into it, how much you jumped into it at, how you allowing yourself to get better. Data, you need the data. You got to continue to grow and understand that everything in life is about receiving data, taking the data, figuring out what's wrong and right about the data and adjusting it accordingly so that you can develop more. That's why you need the data. So get the data, write the stuff down. Just don't be day trading and not write it down. You got to write, folks, you got to write it down. Folks, you got to start recording, because the only way you're going to grow is if you know if you know where you were previously, so that you know where you need to go. That's why you write it down, because past behavior will always be a predictor of future behavior, right? So if I can help adjust my past behavior, then I know that I'm going to grow in the future. But the only way that I'm going to be able to do that is if I write it down. Leave nothing to your memory. Do not trust your memory. You will forget. So let's understand. Let's start writing stuff down. Let's record where we trade. Let's record where we jumped in. Let's record where we jumped out, so that help us to become a better trader. But at the end of the day, guys, you definitely got to have multiple brokerage accounts so that you are able to trade multiple times within a week period. But some of us, because in one count you might have a swing trade, and you might have multiple day trades, but you want to know. But while we swing trade safely amongst other positions every 26 to 36 hours minimum, right? We want to all not get confused. We want to always know where we at. So swing trading is when you buy a stock, remember, again, on Monday, and you sell it on Wednesday or Thursday, right? That's swing trading. A stock that you hold on to for a few or a couple of days, or maybe even a week or a month. That could be a swing trade. But again, a day trade is when you buy a stock the same day and you sell it the same day. More than 4 times a week will get you flagged. But swing trades, you can do it as many times as you want. You will not get flagged as a pattern trader. But again, they do this to make sure poor people don't get rich quickly. Because if I could tell you, there's a major difference in being able to jump in a stock at 550, and you know for sure that you watched like when you learned in our class technical analysis, you know how to trade the gap, and you know the stock's at 550, and you know it's going to go to $6, right? So that's 50 cents. And you know that, bang, man, it's going to it's at 550 right now. I know this thing is going to go back to $6 today. So you jump in it, right? You put two or three grand into it, and then you jump in it. Boom! Once it hits $6, you jump out, and all of a sudden you made $500 to $600 in 10 minutes. But you can't do that multiple times, right? Because you don't have $25,000 in your account. So it's imperative that you have multiple brokerage accounts again, and then so that we can reach the level of 25,000. But don't worry, I'm gonna help you get there. We're gonna get there. We're gonna get to 25,000. But so let's dig into it. Now that we learned that, how do we find and value stocks? It's time to become a fundamental investor and not just the technical investor, because we ought to also understand the technical side and we ought to understand the fundamental side of investing. So a fundamental investor is also considered a value investor, right? We got to understand the value of the company that we're investing in. So that's why we have to learn how to buy stocks at less than their intrinsic value, right? And we kind of simply talked about intrinsic value in the previous class, but we're going to dig deeper into intrinsic value as we go, as the course continues to go on. Like especially next week, we're going to dig into intrinsic value a little bit more. But what is intrinsic value? Intrinsic value is when you buying a company below its current value, right? So if I could catch Apple, right, when it was at $20, and I know that they're innovator of the iPhone, the iPad. I know this company's going to be around in the future. I know this company might be making 100 billion right now, but I know that the company grows 20% annually. So if they're making 100 million and they grow 20% annually, in 10 to 15 years, this company's going to be at $100 billion, right? So and I right now I can get this company on sale at $20 a share before it gets to $200 a share. But we're going to dig way more into intrinsic value than just the stock numbers. I want you to understand the product, the future value of the product that a company creates, what's going to make the company more money in the long run. We have to understand all these things because it is a part of a company's value, their intrinsic value. But a quick way to figure out if a company's undervalued is definitely look at the 10-year window of gradual earnings, right? How's this company been doing over 10 years? Are they making money? Are they losing money? What rate are they growing at in 10 years? Remember we learned about Yahoo Finance. It's time that you start using Yahoo Finance. It's got to become your best friend, because you go on Yahoo Finance and you pull up the company, right? Type in Apple, type in Tesla, whatever stock you're searching, and you type these companies in, it'll pull up, 10 years of earnings, right? And we want to see, are they increasing year over year? How are they doing year over year? I mean, is the company making money year over year? I mean, are they getting better at innovating newer products? I mean, what's happening? How are they doing in a 10-year period? So if I can see in the first year, that they grew 10%, the second year they grew 13%, then the third year they grew another 14%, then the fifth year they grew another 10%. I know the company's on an up trajectory, right? I know they're on an up trajectory. So this is probably a decent company to jump into, right? But you got to start looking at those things before we get into how to become a value investor. We got to first, to do something a little simpler and easier, go look at a company's 10-year earning report. Go look at how they've done in the last 10 years, right? And then that leads me to the next thing, PE, PE ratio, right? It's got to be 22 and under. And remember we talked about FinViz last week? FinViz. Matter of fact, let's go there real quick. Go to FinViz real quick. Let's go to FinViz real quick. It's taking so long. All right, so now we're here at FinViz. Let's take a look. We typed in Apple, right? Let's take a look at Apple. Apple's PE, price to earning ratio is trading at 35.11 times its current value, right? It's trading at 35 times its current value. So if its PE is trading at 35 times its current value, that's a little, I wouldn't say Apple's overvalued, but it's a little bit, I mean, its value is starting to stable out. But you want to find companies with a price to earning ratio of 22 or less. That's how you find undervalued companies. So if we see a PE of a price to earning ratio less than 22, that means the company's only trading at 22 times its current value, 22 times its current value, right? Then that company's undervalued. We want to find companies that are undervalued and jump in them on the low so that we can ride it to the high, right? So you go here to FinViz and you always take a look. The PE ratio of Apple is 35.11 right now. Let's take a look at the PE ratio of Tesla. Tesla is trading at 1,200% times its current earnings. 1,200 times its current earnings. This company is way overvalued. Way overvalued. Way overvalued. So in a 1,200% times its value, right? So we want to continue to find stocks. We want to continue to find stocks that are undervalued. And the way to do that is start looking up a company's PE, price to earnings ratio, right? So if it's trading at 22 times and under its current value, then the company's undervalued and it's time to jump in. And not only that, guys, it's time to start paying attention to a company's credit rating. It's time you start checking people's credit. Everybody always want to check your credit. Now it's time that you start checking businesses' credit, right? You're going to give your money to them. You're going to invest in them. So why wouldn't you check their credit, right? You got to check their credit because you're about to give your money to them. Just like they check your credit when they're about to loan you money, you need to start checking the business credit because you're about to give them your money. So let's just start taking advantage of checking a business credit, right? We got to start checking the credit of a business. But before we dig into that a little bit more, let's talk about a few stocks. Right now is a stock called JNUG. And remember, all these symbols, these ticker symbols, they call ticker symbols, right? They're just smaller handles for what the actual name of the company is, right? Ticker symbols, right? So let's take a look at JNUG. JNUG is a gold ETF, right? And I always live by this. It's called common sense, current events, and calculation. Common sense, current events, and calculations. So common sense tell me, okay, JNUG is a gold ETF right now, sitting at about $90, right? JNUG is sitting at $90. So I want you to understand this. As they begin to print more money into the economy, that's going to lower our dollar. And as it lower our dollar, it causes a physical asset, a real asset, to go up in value, right? As the fiat currency is going down in value, the real asset is going up in value, which is gold. Gold, silver, platinum, real assets, real money. I call it God's money. God money goes up as human money goes down, right? Which is fiat money, our current colorable money, our current currency, the dollar. The dollar, as they continue to print more and more money, as more and more money go into the economy, that causes the dollar to go down. And it causes real money to go up, which is gold, silver, God's money. And as God's money go up, that's going to cause JNUG to go up because it's a gold ETF, right? So that's why I cannot wait till they print that stimulus. Yes, I got stock in JNUG. Why wouldn't I get stock in JNUG? Because I know within the next 2 to 3 weeks that they're going to come to an agreement to print anywhere between a 1.5 to a $1.9 trillion bill. So common sense says that common sense says that not if, but when they agree to that stimulus package, that's going to call more when they agree to the stimulus package, that's going to cause more money to go into the market, right? So more money is going to go into the market. And I know that when more money is placed into the market, it causes inflation, right? And common sense. And if common sense tell me that it causes more inflation, we're going to need a hedge against inflation. And what is that hedge against inflation? A real asset. And what is a real asset? Like I just told you, gold, silver. So we're going to have to hedge against that. And we do that with gold. So that's going to cause gold prices to rise, is because people are going to want to hedge their current dollar, right? Because more money is printed into the economy, which is going to lessen the dollar because of inflation. So, and as inflation goes up, we're going to have a hedge. So everybody's going to be jumping into real assets. So that's going to cause real assets to go up. It's going to cause gold to go up. So, and as gold goes up, that's going to make me more money. That's going to make my pockets more money. Why? Because I'm in this ETF. Because I know common sense says inflation will cause people to hedge against the dollar. Current event says that they're about to print a stimulus. And my calculation says that, hey, man, the inflation is ready to go through the roof. And I've calculated, because I looked at the stock the last time they printed a stimulus, and the time before that they printed a stimulus. So I calculated this thing is going to move from 90 to 150 to 160. That's my calculation. So my price target on this thing is 150. So I'm gonna get about 10 options, right? It's gonna cost me about $5,000, $5,000 to $6,000, but then I'm gonna make 15 to 20,000. Why? Because I understand what happens every time they throw more money into the economy. It's going to cause real assets to go up, and people are going to want to hedge against the dollar. Common sense. So that's why you do things like that. And then we got Saba, right? Let's move on to the next one. We got Saba. Saba, man, this is actually a pretty good company, man. They're trading at $55 right now, $56 right now. I bought more right before the market closed yesterday. I bought more, but Saba, these people are on to something big. Right now, $50 is a gift for this stock. Reason being, $50 is a gift for this stock, because if as they go through their next clinical trial of trying to create therapies or treatments that treats Alzheimer's, they're gonna be the first company in the world to come to a market with an Alzheimer's treatment. So they have no other competitors. They're going to have all the market share until everybody else figures it out. And when they do figure it out, nobody's going to catch them in market share, right? So this company is going to be trading at over $1,000 per share. And right now you can buy it at $55, $56 per share. Of course, I'm getting married to this one. You know, I usually, I date a couple other ones, but I'm marrying this one, because this is a long play. You got to see, it's called LT, long term or short term or near term. You got to learn those what's the abbreviations. So when you see in the market, is this a ST play, meaning short term play? Is this an NT play, meaning near term play? And is this an LT play, meaning long term play, right? So this is my long term play. I'm marrying this stock, right? I'm gonna marry this one because I know where it's going to go, and these people are doing some amazing things, and I stay up on it. And then Palantir, which is PLTR. This is another stock I'm marrying, right? PLTR. Let's talk about PLTR. I know these people are going to be a big part of our future. They have to analyze data and make sense of it, right? And they continue to grow and grow and grow in contracts. But I want you to literally write these down and do your own research on it, because we're going to talk more about these things. And plus, they're going to help you make money, right? These things are going to help you make money. So Palantir, right, is a data software that, all these big companies are going to have to use in order to make sense of their data, because it's like Tesla. Tesla has so much data and they don't even know what to do with it or how to make sense of it. IBM they just got a contract with IBM, right, to help analyze their data so that they can make sense of it, so that IBM as a company can improve and grow more, right? So Palantir is going to be a big thing of the future. They're a big data company, right? They're more than just that, but they're an amazing company. Then we got Gush. What is Gush? Gush is an oil ETF, right? So remember, again, common sense, current events, and calculation. Common sense says, okay, it's an oil ETF. Right now, the economy is still lightweight, shut down, right? Our whole economy, it's not like it. Planes, it's not like it was, a year and a half ago where planes were in the air thriving, cruise lines were thriving, everything was thriving. So a lot of oil was being used. So when the economy opens back up, right? I jumped in this stock, about 4 months, 5 months ago when it was at 20 something dollars, like $22 a share. And now it's currently at $65 a share, right? I've already made about $14,000 off this stock. And of course, I'm gonna stay married to it for a while, because at the end of the day, I know the same stock almost 2 years ago was trading at $800, right? So if it was trading at $800 and it's currently at $65, it's still on sale, right? So we're trading way below its value, still on sale. Even though I got it at 20, it's still on sale. Because if it goes back to half of what it was, then I know it's going to make me over $200,000, right? $200,000 to $300,000 if it goes back to where it was. And you know what? I'm in this for the long game. I'm willing to wait. So if I have to wait 2 years for it to go back to 400, which is going to make me $200,000, right? That's $100,000 a year that my money made for me. That's why these things happen like this. So Gush is an oil ETF, right? So if Gush is an oil ETF, when soon as planes get back in the air, as soon as those cruise lines, they all use gas, right? As soon as more cars get out on the road, they all use gas, right? And all of a sudden, Joe Biden is also trying to put a damper in the U.S. Production of oil. So we're going to need this oil from Saudi Arabia, which is going to cause it to go up more of a barrel because he don't want us digging for oil here in the United States. So it's going to cause us to have to go other places, right? And then they're going to jack the price up. And as the price of oil rise, so does Gush, right? So you got to see, this is how these things are going to happen. Common sense, current events, and calculation. That's all you need to think about before you jump in a stock. Common sense that this stock is going to go back up the moment they free up, the moment the economy is fully opened back up, this stock is going to shoot to the moon. Common sense, right? And then oil's not going anywhere, no matter what. I know all these electric vehicles, oil's not going to, they use plastic. You have to make plastic, you have to have oil, right? So just know that all this, when cruise ships get back out there and all these planes really start flying like they was flying on the schedule a year and a half ago, this thing's going to shoot up. And you want to make money when it does. So $60 right now, it's on sale. Then let's talk about IBM. IBM's another one. IBM's been in business a very long time. They got a good credit rating. They've been in business a very long time. So IBM's another great company. They just started their cloud computing, cloud storage computing database. So they're innovating for the future. They see where the future is going. And then you got Tesla, right? We already know Tesla's the big dog, of EV vehicles, and they made it to market. They done their thing, and Tesla's more than just a car company. Come remember again, common sense, current events, calculation. Tesla is more than just a car company. Man, they have what? They have solar. They install solar on roofs. They have battery storage. They have their own insurance. Come on, man. Tesla's on the road. Tesla's going to be the GOAT, real GOAT. Right now it's at, $780 a share. Around 780s a share, right? It won't be there long. I know it floats, but one thing I don't do is I never bet against Elon Musk. The man's a beast. I don't bet against him. So when I jump in that company, I know who I'm in bed with. I know who I'm married to, because at the end of the day, I watch this man almost go bankrupt trying to make Tesla happen, right? So Tesla's going to continue to do nothing but grow. I predict that it'll be at $1,200 to $1,300 within a year. And right now I can get it at $780 on sale, right? GE's been around another long-term company. It's been around a long time. But I know that GE is big on creating the Internet of Things, which is where our future is going. Common sense. Our future is going towards the Internet of Things products. What that means is everything is going to be eventually connected to the internet. When you go buy a stove, it's going to be connected to the internet. Your refrigerator is going to be connected to the internet. Your dishwasher, everything is going to be connected to the internet. The toys you buy for your kids is going to be able to connect to the internet. It's called the Internet of Things. We are going into the future. Everything is going to be connected to the internet. That's why it's called the Internet of Things. Right now, your TV, I mean, if you got a TV these days, most of all of my smart TVs now, right, they connect straight to the internet, right? So there's going to be a slew of products that's going to be connected to the internet. It's called the Internet of Things. And GE is producing a lot of products that's connected to the internet. They're going to be the goats of creating the Internet of Things products, right? So why would I not invest in them? Again, common sense, current events, calculation. And then that leads us to Bitcoin. You know, BTC, Bitcoin, that's the ticker symbol, BTC. That leads us to Bitcoin, BTC. You know, Bitcoin. I don't want to get into a whole discussion with you, but I know that Bitcoin is going to be at 250 to 500,000 within the next 2 years. Why? Again, remember we talked about money and how they're printing all this money? There either going to have to be a great reset or a change of currency. And just pay attention to what's going on right now. Why is all these companies accepting? Why is all these major companies starting to buy into Bitcoin? All these institutions are starting to buy Bitcoin. Banks are starting to buy Bitcoin. Hey, y'all better pay attention to what's going on, because we're going to a cashless society. I mean, right now, China's the forerunner in creating a cashless society. They got cities that don't accept cash anymore, only all digital. So y'all better pay attention to what's going on. Bitcoin right now is at 56,000. I was telling y'all, if you've been following me on Instagram and Facebook, I've been telling you to buy Bitcoin when it was 16,000, right? I told you to buy when it was 16, when it was 17, when it was 18. Now it's at $56,000, right? This thing is going to, this time next year, Bitcoin would be over $100,000. It would be over $100,000. So if you can get your parents, your grandparents, your cousin, your uncle, your auntie, your cousins, your friends, everybody to come together to buy one coin, and you know that it's going to $500,000 within the next 2 to 3 years, why won't you do that? Why won't you do that? Why won't you collect money or put something into it, right? But if we can't, but we know where Bitcoin is going, because again, it's going to be, I believe, in my opinion, I believe it's going to be the currency of the world one day, the reserve currency of the world one day. Right now, the US dollar is the reserve currency of the world, but that's falling every day, especially as they continue to print more money. So there's one or two things that's going to happen: a great reset, or they're going to have to change up our monetary value from the current fiat currency to a real asset, which will be Bitcoin, right? It's a digital asset. One of the two things are going to happen. So which Bitcoin is going to come out a winner on both ends. So it's going to be a cashless society. We're already moving towards a cashless society. There will not be any cash. Your kids 10 years from now will not be using fiat currency. What is fiat? Colorable money. Fiat currency, the paper money. You will not be using it in 10 years. It will be gone. So common sense, current events, and calculations. So if fiat money is going to be gone, then you better start investing into digital money, right? So, and that leads me to the next, Ethereum, ETH. The ticker symbol is Ethereum, ETH. Ethereum is going to be, it's also a cryptocurrency, a digital currency, but this is a digital currency with the ability to do smart contracting. So if me and you come to agreement, I'll pay you through Ethereum that acts as a contract. Or let's say I want to sell you a portion of my house, right? I want to sell you a portion of my house, or give you ownership or into a property of mine. Okay, let's do a ETH, or let's do an Ethereum smart contract. So boom, I don't have to go through all these legalities. I don't have to get all these attorneys. I don't have to hire all these people. No, we just get together a smart contract. Boom, you pay me and an Ethereum token. The Ethereum token, it records it on its ledger about our contract, and boom, look, we have an agreement that's on file, that's legal binding. Instead of going through all these lawyers have to pay this and this titling company and that and this, and everybody's collecting all these fees, no more of that. Ethereum's going to take that away. So while Ethereum, I told y'all to start buying it when it was at $500 or $600. It's at $1,900 right now. And then that leads us to the next, XLM, right? You can buy all these coins on Coinbase.com, Crypto.com, Coinbase.com, CoinbasePro.com, or Crypto.com. And then we leave us next to XLM. What is XLM? It's called Stellar Lumen, right? It's a stable coin. A stable coin is a digital currency that's a stable coin. Stable coins are tied to a physical asset, right? So that's what makes it a stable coin. XLM, I was telling y'all to buy it when it's at 8 cents. Now it's at 52 cents. And as a matter of fact, they have agreement of becoming the stable coin for the US dollar. So if they're going to help create the digital currency of the US dollar, why would I not jump into Stellar Lumen? Why would I not jump into this? Remember again, common sense, current events, calculation. Current event is they're tied to the US dollar, the US crypto dollar. It's coming. The Federal Reserve is already working on it, folks. It's going to happen. We are moving to a cashless society. So why would I not get in this digital currency on the ground floor? It's at 52 cents right now. It's still on sale. Still on sale. I bought hundreds of thousands of it at 8 cents. Why? Because I know what it's going to do. This thing is going to make all these Bitcoins, Ethereum, XLM is going to make me not a millionaire, a billionaire. I'm not looking for millions. I'm looking to make billions in this, right? Because I understand what's happening. Remember, common sense, current events, and calculation. A lot of this is going to make people millionaires. This is going to make people millionaires. If you're getting in on all these stocks at the ground floor, especially Bitcoin and Ethereum and XLM, which is Stellar Lumen, if you're getting in on this ground floor, it's going to make people billionaires, millionaires, billionaires, hundredaires. It's going to make you an heir so that you can be able to pass down to future generations. But definitely do your homework on these things. Don't take my word for it. Do your homework. See where the future's going. Look up Bitcoin. Go on YouTube, type in Bitcoin. Type in the future of digital currency. Look up Tesla. Look up IBM. Look up Sava. Look up Palantir. Look up Gush. Look up all these things I'm telling you about. Don't take my word for it. Do your own research. Find out. Hey man, find out. Donnie's on to something. Yeah, I know. But I want you to find out for yourself, because that'll give you more of a conviction than me just telling you. So literally take the time. Why would you invest in yourself? Take time out of your day to start investing into yourself, into the future of your family, into the future of you. What could you do? What if you invested $8 in this? What could you do with a couple hundred? I mean, not a couple. What could you do with $1 million right now? What could $1 million do for you? What if I tell you that if you put, $2,000-$3,000 in the Stellar, that will make you a millionaire in the next 5 to 10 years? Would you do it? Right? So, and what would that do for your family in 5 to 10 years? You got to start thinking that. So you can't take 10 to 20 to 30 to 40 to 50 to 60 minutes out of your day and to study things that could potentially take your life, take the future life to a whole nother level? Why wouldn't you not study these things? So please, folks, I'm begging you, take your time out, start digging into this stuff. Dig into all these stocks that you see right here on this page. Literally dig into it. And that leads us to the next. But we got to talk about business credit, but we're going to go way more in depth into business credit as we continue to go through the course of fundamental analysis, because you got to not only learn technical analysis, but you also have to have fundamental analysis. But before we really dig into business credit, I want you to understand that companies with a BBB plus or better has a good credit rating. BBB and below, not so of a good rating. We probably don't want to jump into those companies, especially if they got 70% in debt. It's companies that, no, we don't want to jump into those because they had debt loaded to their head. So BBB plus and above is companies with a good credit rating, right? And BBB and below, not so good. So remember, BBB plus and above, good. BBB and below, not so good. But we're going to dig into this more next week, because I don't want to make this. I literally just did this class as a concession. you know, something that we can do real fast. But let's real quick. Let's talk about dividend investing real quick. What is dividend investing? Dividend investing is that you are entitled to a percentage of the profit of the company that you invest in. So a lot of blue chip companies, you know, blue chip stocks are have dividends, right? And dividends are a way of the company giving you back some of the profit that it made. So okay, so remember when we talked about in the beginning of the class that when you buy a share, you're buying a fractional ownership into a company. And when you buy fractional ownership into a company, okay, the company is saying, okay, let me give you some more money. We're all going to share in the profits. Let me throw you some. We had a great year this year. Let's go ahead and throw you some more money, right? Besides the stock going up, they also throw you money on top of your money, right? So as a fractional owner into this company, you are entitled to a piece of the pie. And because you're entitled to a piece of the pie, they give it to you in dividends, right? So what is a dividend? Let's say a company right now says that they're giving you a dividend of $1, right, per share. So for every share that you own, they're going to give you $1 in profit for owning that share. So let me say it again. For every share that you own, they're going to give you $1 in profit for owning that share. So let's say the share price is at 10, right? So how do you calculate the percentage of a dividend? You divide 1 divided by 10, not 10 divided by 1 divided by 10, that gives you a percentage of 5%. So let's say it again. 1 divided into 10 comes out to 5%, not 10 divided into 1. No, it's 1 divided into 10. You take the dividend price, right? The dividend, how much they're giving you per share, and you divide that by the share price, which you would come out to a dividend yield of 5%. So if I invested $5,000 in a stock, which would give me 500 shares, and now the 500 shares is $1 per share, I know at a 5%, at a 5% annual rate, right? At a 5% annual rate, that's going to make me $250 a year. That's $62.50 a quarter, right? So if I jump in this stuff, invest 5,000 into this stock, and as the stock continues to grow, I continue to make money, right? But I know that it's going to pay me $250 a year just for my money sitting there into that company. So this is called passive income, folks. This is a way to start creating passive income for you and your family. I put 5,000 in it. It pays me $250 a year or $62.50 a week. So now my money's making money for me. I want to get this to, you want to get where you invest into a stock and it's paying you $50,000 back a year, right? And if you can get it paying you $50,000 back a year, what could an extra $3,000 to $4,000 do for you a month? What could that do to your life? How could that help you? If you made an extra $4,000 to $3,000 a month, how much more could that help you in your life? Right? So we got to start thinking about these things, that we invest in the companies that invest back into us. We invest in the companies that invest back into you. So if I continue to buy dividends, right? Dividend investing, we call it the DRIP, dividend reinvesting program. So I take the same dividends that they paid me, they invested in me, and I invested it right back into the company so that I can buy more shares of it, right? So that way my money continues to accumulate. It continues to grow and grow and grow and grow and grow more. So like, for instance, so if I get $1 at 5%, I'm earning 250 cents. If the share goes down and I'm still but the dividend goes up, right? That's going to make me $330 per year. And as the stock continues to go down and the dividends go up to 10% a year, it's going to make me $500 a year if I got 5,000 invested, right? And if the stock goes down even more, I really love this one, then they're going to pay me 20%. But you also understand 20% is a very high number of a dividend for a stock. But look, we're going to dig into all that though. So at 20% in dividends, and I got $5,000 invested, that will pay me $1,000 a year or $250 every quarter. Now my money's making money for me, right? My money's making money for me. That's an extra $85, $90 a month that I'm making in income that I did not use my time for. because you got to understand the only way to become rich is you stop trading your time for money. You got to stop trading your time for money. If you want to grow your income, because there's only so many jobs you can work, so many hours in a day. In order to become wealthy, you have to stop learning to trade your time for money. You got to start building meaningful relationships. This is how the rich become richer, and this is how you get wealth. Period. Stop trading time for money and build your network. And I'm not talking about a network of people who makes the same amount of income as you or way less than you. I'm talking about a network of people who makes double the amount that you make. You got to start finding these people. You got to start building your network. You got to start building these things up, right? This is what you got to start doing. So let's dividend investing. But again, let's capitalize. As the stock goes up, the dividends go down, right? As the stock goes up, the dividends go down. And as the stock goes up, I'm sorry, as the dividends, I don't know how I got it, but as the stock goes up, the dividends go down. And as the dividends go up, the stock goes down. All right. So as the dividends go up, right, the stock comes down. And as the stock goes up, the dividends come down. Let me say it again. As the stock go up, the dividends come down. And as the dividends go up, the stock come down. This is wrong. This is wrong. My team put it in the wrong place. Dividend's supposed to be over here. But dividend's supposed to be right here. The stock's supposed to be right here. So let's get to understand. As the stock goes up, dividends come down, right? And as dividends go up, the stock comes down. But you always want to know, right? Why did the dividend go up? And why is the stock going down? Because anything over, anything over 5%, the company's undervalued. But we got to find out why the company's undervalued. Why are they paying such a high dividend yield? Anything over 5%, the dividend yield should always raise a flag because that's pretty high. And it should raise a flag because you want to know what's going on. Like, is this company bleeding money? Are they in need for money? They don't want people to punch out of the stock. That's why they're raising the dividend so high so that people stay in because they're earning money on their money. Like, why is the dividend so high? I know Gush made the dividend high. I mean, Gush dividend went up to 18%. But I know that they needed money to survive during the pandemic, and I know there was a good oil ETF, right? So I kept my money in there because they're paying me 18% on my money to hold my money while the economy recovers. So I'm okay with that. But a company that's paying you 18% because they're about to go bankruptcy, they ain't creating no new products, they're not innovating, they're not pivoting, there's no way to go, then it's time that we take a look and we might have to jump out of their stock, right? And companies that have a stock 4% and below are usually overvalued. But I'm okay with that because companies that are overvalued, that are stable, and they pay you 1 to 2% of dividend, but they're not going anywhere, that's worth it, right? That's worth it. That's worth it. But it's time to start building your portfolio. It's time that you start taking a look and do your homework in these stocks and you start with building a portfolio. As a group of assets, like a group of stocks that you put together under one roof. It's time that you start doing that. So we're going to talk about more about portfolio building next week, or the weeks to come. But it's time for you to start thinking about building a portfolio. Portfolio can be made up of assets like real estate, stock. It can be made up of many different things, but it's time that you start building it. It's time. This is the first step to wealth. That's why I call this class the stock market, investing 101, because it's the time. We're about to start investing. It's time to get the money, right? So think about it. It's time to start creating a portfolio. But please, folks, don't forget to subscribe, follow, and like if you find this information to be very valuable to you. I know I did, even sitting here listening to myself and all my jibber jabber talking. But if you find this information to be valuable, it's time that you start investing like the professionals do. It's time that you start creating wealth for you, yourself, and your family, and generational wealth. But don't forget to subscribe. Don't forget to follow. Please, if you're not on YouTube following Your Wealthy Wallet, go on YouTube, follow Your Wealthy Wallet, and subscribe. Make sure you follow and like on all channels. Thank y'all so much again, and I'll see you next week, family.